In this video, we discuss Chapter 17 about retirement accounts in our book, Next Gen Dollars and Cents. You know, the topic of retirement accounts and the different account options that are out there, plus the tax implications, really are decisions that everybody faces on a pretty regular basis. Retirement accounts such as IRAs, 401ks, 403bs are all tax advantage savings options with no immediate tax implications on the earnings that occur inside of those accounts. However, though, depending on your age, withdrawals as you take money from these accounts can spur some tax consequences and penalties that you certainly need to be aware of. The two perhaps more common types of accounts that we encounter are the traditional IRA and the Roth IRA, which are two different types of individual retirement accounts. These accounts allow folks to save directly for retirement on a tax-deferred basis, but they have significant differences. So a traditional IRA allows for contributions that are going to be tax deductible on your tax return. When you do use that money in retirement, take money out of that account, those withdrawals are then taxed as ordinary income. On the other hand, a Roth IRA does not allow for a tax deduction as you make contributions to that type of account. So it's going to be an after-tax type of contribution. But when you take those distributions, use that money out of that Roth account in retirement, it is tax-free. So deciding between a traditional IRA or a Roth IRA is really a consideration of whether to pay taxes now or pay taxes later. Traditional IRAs particularly benefit folks that expect to be in a lower tax bracket in retirement. On the other hand, Roth IRAs, because they offer those tax-free withdrawals during retirement, that would be advantageous if someone's going to be in a higher tax bracket in retirement. Our book, Next Gen Dollars and Cents, features a chart that actually helps to sort of lay out these differences between traditional IRAs and Roth IRAs. One of the important considerations to put into the mix as you're deciding between these two different types of IRAs, traditional or Roth, is that there's various eligibility requirements that you have to make sure that you're following. First, you have to have earned income. You can't fund a retirement account without earned income. There's also contribution limits imposed by the IRS for the year 2025 in an IRA and a Roth IRA. That contribution limit is $7,000. If you're over age 50, you can put an extra $1,000 into it. In terms of the eligibility criteria for deducting contributions, it's actually quite complex when we think about trying to deduct a contribution to a traditional IRA. It depends first on whether you have an employer-sponsored plan available to you where you work. There is a big flow chart that we've got in our book, Next Gen Dollars and Cents, dedicated to working through the different decision tree steps that you would need to make in order to be able to properly deduct an IRA contribution. In addition, income limits also apply to one's ability to contribute to a Roth IRA as well. So obviously ensuring proper eligibility for a traditional or a Roth IRA contribution is complicated. So make sure you take the time to make the right decision on which one is going to make the most amount of sense for you. You know, a popular suggestion these days is the notion of Roth conversions, where you start with an amount that is in a traditional IRA and then convert those assets over to a Roth IRA. And while certainly there can be some numerous benefits to this conversion process, it's also a highly misunderstood concept that oftentimes you'll hear suggested as the pathway to a tax-free retirement. And while that might be true at the end of the day, between now and when you get there, there are some significant consequences, particularly if you're engaging in Roth conversions, because when you do a conversion, the entire amount that you convert is fully taxable in the year in which you do the conversion. So obviously that additional amount of income on your tax return might very well create a much greater tax burden than the value of having those withdrawals be tax-free at retirement. So a conversion is certainly something that needs to be carefully planned to address the numerous potential tax issues that might apply. Employer-sponsored plans are, in contrast to IRAs or Roths, where you set those up on an individual basis, employer-sponsored plans are retirement savings plans and accounts that are offered by employers to employees. Employers will often, of course, incentivize employee participation by offering matching contributions as an employee benefit. And let me be clear on this. If your employer offers to match some of your contributions, I compel you to participate, because fully contributing the necessary amount ensures that you're going to get the entire employer match. If you don't do that, it's kind of like you're leaving free money on the table. So you want to certainly avoid that. Different employer retirement plans allow employees to make either pre-tax or after-tax contributions with much higher contribution limits than the IRAs. For your 401ks, 403bs, those types of employer-sponsored plans, the contribution limit for 2025 is $23,000. If you're over age 50, you get to do an additional $7,500 contribution as well. A variety of employer-sponsored plans, 401ks, typically where you would see that offered by a private or public for-profit type of company. 403b, typically offered to employees of nonprofit organizations. 457 is offered to government employees. Often that's known as a deferred compensation plan. And then lastly, a SEP IRA is an employer plan available to self-employed individuals. So you want to make sure when you're using an employer-sponsored retirement plan that you take the time to review all of the investment options within the plan to make sure that you're creating the right asset allocation that works best for you. Make sure you carefully evaluate all those choices inside the plan, and obviously look for those investment options with solid long-term track record and low expenses. Now, when you leave your employer, you should take your money with you. Just as you wouldn't leave your family photo on your former desk, you shouldn't leave your money behind either. The process of taking your money with you is done through something called a rollover, which allows you to move tax-free your money to another qualified account that you can even add contributions to as well. Chapter 17 on retirement accounts in the book also has a section on the options within the Florida retirement system. Since Nelson Financial Planning is a Florida-based firm, we included that. Certainly for more details on those options within the Florida retirement system, make sure you check out our Florida retirement system pamphlet that's available on our website at nelsonfinancialplanning.com. The chapter 17 of the book continues with the discussion about retirement account withdrawals, and withdrawing money from a retirement account in the most tax-efficient manner requires that you understand a variety of different factors and situations that will vary by account type. Regular withdrawals that are made during retirement years are not going to be subject to any particular tax penalty as long as they occur after age 59 and a half. However, early withdrawals, meaning those made before 59 and a half, are typically going to be subject to an additional 10% tax penalty. Now, there's a variety of exceptions to that early withdrawal 10% tax penalty. Among them, higher education expenses, a down payment of up to $10,000 on our first-time home. In addition, there's a couple of unique exceptions that exist from the 10% tax penalty in very specific early retirement scenarios for individuals that are retiring over the age of 55 or retiring from specific high-risk jobs. Now, Roth IRAs are obviously treated very differently because the original contribution can be withdrawn tax and penalty-free at any age. However, once all of your initial contributions have been withdrawn, the remaining earnings from your Roth IRA can certainly be taxable and subject to a 10% penalty as an early withdrawal if you're using that money before age 59 and a half. Again, the operative age to really be aware of here is 59 and a half in order to sort of avoid the potential of that 10% tax penalty on those early withdrawals. On the flip side, you have required minimum distributions once you hit the age of 73. That, in fact, is actually going to increase to age 75 in the year 2033. Those required minimum distributions only apply to traditional or regular retirement accounts. They do not apply to Roth. So you don't have that RMD that applies on a Roth account. Now, the required minimum distribution is based on an individual's age and total retirement account balance. Typically, that starts out at around 4% of the account balance and gradually grows with your age. For the vast majority of retirees that we see, their normal level of retirement income sort of satisfies that required minimum distribution amount. So the required minimum distribution amount isn't some extra amount that you have to take beyond, of course, the required minimum amount. The book also talks about qualified charitable distributions, or QCDs. They're one of the most valuable tax savings options for charitable-minded individuals regarding their required minimum distributions. Some very specific rules here that need to be followed, but some real tax benefits if done right. Chapter 17 of our book concludes with a discussion about inherited IRAs. Now, an inherited IRA is received by a named beneficiary, whether that's spouse, a child, or another individual, and they receive that, of course, after the original IRA owner passes away. These then become what is known as inherited or beneficiary IRAs, and these types of retirement accounts have very distinct distribution rules that can, in fact, be quite complicated. Now, while there's no early distribution penalties, meaning it doesn't matter how old you are, if you take money out of an inherited account, you don't have to worry about that early withdrawal 10% tax penalty. Regardless, there are still some very specific required distribution schedules that need to be observed. The biggest of which is that if you inherited a retirement account after January 1 of 2020, the total payout of that inherited account must now occur within a 10-year period of time. Obviously, some exceptions exist, particularly in the case of a spouse, where you can assume that as your own. But the reality is that if you are a child or grandchild of the IRA account owner who passed, then you have to observe this rule that requires you to take all of the money out of the account within a 10-year period of time. And this rule applies not just to regular IRAs, but also to Roth IRAs. Obviously, the concept there is that it then substantially accelerates the tax implications of inheriting that retirement account. So the rules for inherited or beneficiary IRAs are really can be quite complex, and they've gotten much more complex over the years, particularly with that accelerated 10-year payout. So we certainly recommend that individuals who inherit an IRA engage in extensive planning to ensure the most tax-efficient distribution strategy. Similarly, generating income from investment accounts to provide money for retirement income planning is a very highly specialized process as well. Retirement income planning certainly depends on a variety of factors that need to be taken into account when taking withdrawals, and how much of the withdrawals should be taken from which particular type of an account is all part of that retirement income planning. You know, at Nelson Financial Planning, we typically start sort of mapping that out, an individual's retirement income strategy, a few years, in fact, before the actual retirement. So for much more details on these retirement account concepts covered in this video, we encourage you to read Chapter 17 of our book, Next Gen Dollars and Cents. You can get your free copy of our book by texting free copy to 407-791-0070. That's 407-791-0070. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, and author of Next Gen Dollars and Cents. Thanks for watching this video.